Okay, so let's start. We want to start this new area of external reconstruction. So let me introduce it. We started the topic of reconstruction, and we said for a company to be reconstructed, just as a reminder, why do we reconstruct a company? We said we normally reconstruct a company because it has been making losses over a long period of time. And we said for you to reconstruct that company, we said there are two ways in which you can reconstruct a company. One way is through what we were calling internal reconstruction, and the second way is through what we call external reconstruction. We have already covered the internal reconstruction. So today we want to look at how to reconstruct a company through external reconstruction. So let me introduce how then do we reconstruct a company through external reconstruction. I want to start by assuming that we are reconstructing a company called A. This company has been making losses, and therefore the most logical way to do it is to reconstruct this company. So when it comes to external reconstruction, company A will be liquidated. Company A will have to liquidate themselves, and they will have to sell their business to another company. Let's call it company B. Company B could be another existing company, or it could be another newly formed company. So you can form a company to take over another business. You form a new company to take over another business. Okay, so company A has to liquidate themselves so that they sell their business to another company. Now, we normally refer to company A as the selling company, and we normally refer to company B as the purchasing company. So in most questions, whenever you are tested in this area of external reconstruction, the examiner will ask you to show the entries in the books of the selling company. Remember, they must liquidate themselves. The examiner will also ask you to show the entries in the books of the purchasing company. Now, company A will have to close their books. Company A will have to close their books, while company B will be required to open their books. Okay, so I have said, when does an external reconstruction occur? I have said external reconstruction takes place where a company is liquidated and they sell their business to another newly formed or existing company. Another point is this. I have said company A must be liquidated. It means that by the end of the day, the stakeholders of the company A must be paid what is due to them so that they sell their business to company B. So the stakeholders of company A may include the ordinary shareholders, it may include the preference shareholders, the debenture holders. All the stakeholders of company A must be paid what is due to them. You know, when a company is liquidated, normally the owners of the company are paid what is due to them. So ideally, that's what we are going to do for company A. We sell the business, we liquidate it, pay the owners, and everybody will go their way. So I want to introduce what are the accounting entries. What are the accounting entries in the books of the selling company? What are the accounting entries in the books of the selling company? So let me introduce them first before we write something down. So we want to discuss the entries in the books of the selling company. Entries in the books of the selling company. We are using company A as our selling company. They are selling their business to company B. They are selling their business to company B. Now, so there are several entries that company A will have to make in their books to close their books so that they sell their business to company A. No, company B, sorry. Number one, company A, listen, could be giving some of their assets to company B. In other words, B says, I'm going to take over your motor vehicle, I'm going to take over your furniture, your stocks, your data, and so on. So what do? You as company A, with the assets that are being taken over from you by the purchasing company. So you as company A, step number one is to close all assets taken over. Close all assets taken over by the purchasing company at their book values. At their book values, you close them at their book values to an account we shall be calling realization account. To an account we shall be calling realization account. So let me show here that account in case you are required to. Of course you will be required, because this, when you are asked this topic, you will be required to show the entries in the books of the selling. So you will open an account called realization account. Listen, we are saying step number one, close all assets taken over at their book values to the realization. We know assets are always a debit balance. We know assets are always a debit balance, and therefore to close them, you will credit the assets and you will debit realization. You will credit the assets and debit realization. That's our step number one, which says close all assets taken over at their book values to the realization account. That's step number one. Number two, again, listen. Number two, company B might tell us they are willing to take over maybe some of our liabilities. Maybe they want to take over our creditors, they want to take over our loans, debentures, and so on. Number two, with the liabilities taken over, what do? You close them again. With the liabilities taken over, you close them to this account we are calling realization account. We know liabilities are always a credit balance, and therefore to close that credit balance, you will have to debit that liability and you will have to credit this account called realization. That is our step number two, which says with the liabilities taken over, you debit liabilities, you credit realization. That's number two. We got number three now. I've already said company A is selling their business to company B. So it is obvious therefore that you as company A, you must be charging something to company B. You are selling your business to company A. No, you are selling your business to company B. So there must be something you are charging them. What is it that you are charging them to buy you? That which you are charging them to buy you is what we normally refer to as the purchase consideration. So our step number three says, with the purchase consideration, what is it that you as company A, you are charging company B? It could be that the question tells you, or you realize that you are charging company B, let us assume some 50 million. You are charging company B 50 million to buy you. I am not saying, listen, I am not saying company B is paying me 50 million now. No, we are not receiving it now. We shall receive it later. But for now, I want to charge company B with that 50 million. In other words, I want to create a data. Me as company A, I create a data by the name of company B in my books. That's what we are saying. You charge them that 50 million. You charge them that 50 million. So step number three says, with the purchase consideration, whatever it is, you will debit the purchasing company, which I'm referring to company B Limited. You will debit them by that 50 million and you will credit realization, and you credit realization, and you say here B Limited, that is 50 million. That's our step number 3, which says with the purchase consideration, you debit the purchasing company, you credit realization. Listen, by debiting this purchasing company, we are creating a data. They are not paying me now, they will pay me later. But for now, let me create a data by the name of company B. So I debit the purchasing company, I credit realization. I credit realization. That's our step number 3. Let me go to step number 4. Number 4. We have said company A must be liquidated. Company A must be liquidated. And so in the process of them liquidating themselves, they will be required, or they may be required, to incur some liquidation expenses. Of course, when you are liquidating yourself, there could be cost of liquidation. Okay? That cost of liquidating, it is your responsibility as company A for you to liquidate yourself. You are required to liquidate yourself so that you sell your business to company B. So with the liquidation expenses, we are saying number 4, with liquidation expenses. Listen, if you company A, you paid it on your own. You as company A, you paid your liquidation expenses on your own. You will debit this account we are calling realization. You will debit this account we are calling realization, and you will credit bank with any liquidation expenses. You will debit realization and you credit bank. Okay, now listen, it may be, yes, you are supposed to liquidate yourself, you as company A, and it's normally your responsibility to liquidate yourself. But listen, but you as company A, you don't have the money to liquidate yourself. Maybe you needed 2 million shillings for you to liquidate yourself, but you don't have your money, you don't have that 2 million to liquidate yourself. Listen, but because company B still wants to buy you, company B might say they are going to pay for you, that liquidation expense. They are going to pay for you that liquidation expense. In that case, listen, that is not their cost, it is your cost, you A, but it is being paid for you by B. That means it's being paid on your behalf, but it is you A who incurs that cost. So we normally say, if you company A, you incurred it but never paid, you incurred it, it will be paid for you by B on your behalf. Then listen, if you company A, you incurred but never paid for that liquidation expense, then you create a liability now in your books, so that once you receive the 2 million, you will later pay. In that case, you will debit realization and you will credit an account we shall be calling provision for liquidation expense. You will credit an account called provision for liquidation expense. Once you realize from the question that it is the company B paying for the liquidation expense on behalf of company A, So you A, you will debit realization and you will credit this account called provision for liquidation expense by whatever the amount. That is our step number 4, which says with the liquidation expenses, if paid, you will debit realization, credit bank. Okay? If incurred but not paid, you still debit realization and you credit provision for liquidation expense. Good. Let me go to step number 5 now. For step number 5, I want to take you back to number 1. For step number 5, I want to take you back to step number 1. Number 1, we have said, close all assets taken over. Close all assets taken over by the purchasing company. It may be, listen, it may be company B does not want to take over your furniture or your motor vehicle. Yet, we have said company A must liquidate themselves. Listen, when a company is liquidated, there should be no account pending after liquidation. So if there is an asset that company B does not want to take it over from us, what do we do as company A? You may decide to sell it on your own. You get somebody to sell to and you sell. So that's our step number 5 that says, with any assets not taken over, with any assets not taken over, but sold by the selling company, what do? You will go and debit bank. Remember, you are selling your asset. You as company A, you are selling your asset. You will debit bank and you credit the asset. Let us assume it's an asset called motor vehicle. Which could be having a book value of, let's say, 2 million. You sold it for 1.5 million. You sold it for 1.5 million. So you will debit bank by that 1.5 million and you credit the asset called motor vehicle by 1.5. Okay? Of course, you can't leave this account pending. You can't leave it pending. Remember, you have sold the motor vehicle, but there is a balance of 500 in this account. That 500 could be a gain or loss on disposal. That 500 could be a gain or loss on disposal. And in this case, it's a loss on disposal. So with that loss, which is the balance in this account, you will credit the asset, listen, and you debit realization. Listen, you debit realization. Remember, listen, we are not running a normal business. If we were running a normal business, I would take that loss on disposal to the profit and loss. We are not running a normal business. We are liquidating this company. And so our operating account becomes the realization account. So whatever is the gain or loss on disposal, it could be a gain. If you sold it for 2.5, when it had a book value of 2 million, then you sold it at a gain. But we are saying that gain should not go to the P&L. No, we are not running a normal business. If we were running a normal business, it would have gone to the P&L account. But now we are not running a normal business. We are reconstructing the company. And of course, our operating account is the realization account. So that's all for step number 5, which says, with any assets not taken over by the purchasing company but sold by the selling company, you will debit bank and credit the asset. Then I'm saying, with any balance in the asset account being either gain or loss on disposal, you transfer it to the realization account. That's our step number 5. Let me talk about number 6. For number 6, again, I want to take you back to number 2. For number 6, I want to take you back to step number 2. In number 2, we said, with liabilities taken over. Maybe the company B took over your bank loan. They took over your creditor. Maybe they took over your bank loan. They took over your debentures. But suppose they decided they're not going to take over your creditors. So what do? Again, and remember, we are liquidating this company. Yet, there is a liability that company B does not want to take over. What do? You as company A, you may decide to pay that liability on your own. That is it. Because we are liquidating the company, we can't leave any account pending. All accounts must be closed. So if there is such a liability which was not taken over by the purchasing company but paid by you, the selling company, what do? So we come and say number 6, we are saying with liabilities not taken over, but paid by the selling company. of course you will debit the liability. Don't forget, liabilities are always a credit balance. Liabilities are always a credit balance, and therefore you will credit you credit bank and you debit the liability. Let us assume that the liability is creditors. Okay, we are assuming our liability is creditors here, and I want to assume that the creditors liability amounted to 2 million. Suppose the question tells you the creditors were willing to accept 1.8 million in full settlement. 1.8 million in full settlement. So you must have debited creditors, you must have credited bank, maybe by 1.8 million. Again, we can't leave this account pending. We can't leave this account pending. We owe them 2 million. They were willing to accept 1.8 in full settlement. Okay? So it means therefore that the creditors have given me a discount of 200. That is a discount received. It's a gain. Listen, again, we are not running a normal business, so I can't take it to the P&L. If we were running a normal business, that gain of 200, which is discount received, I would have taken it to the P&L. But because we are not running a normal business, I will take it to the operating account, which we are calling realization. So that's our step number 6, which says, with the liabilities not taken over, but paid by the selling company, you debit liability and you credit bank. And with any discount received from creditors, you will debit creditors and you credit realization. That's our step number 6. Let me go to number 7 now. Let me go to number 7. Now, another point, listen to this now. Number 7. I told you when I began that we are liquidating company A. And whenever company is liquidated, I said all the stakeholders of that company should be paid what is due to them. Now, one group of stakeholders are the ordinary shareholders. Now, in a company, there is a lot that you as a company, you owe to your ordinary shareholders. One thing you owe to them is their ordinary share capital. You also owe to them their share premium. Any reserves that are available in the balance sheet, like general reserve, revaluation reserve, all that belongs to the ordinary shareholders. Okay? So we are now saying a time has come now where we need to think of how we shall pay them, what is due to them. Listen, but the point is, we don't pay the ordinary shareholders what is due to them through those accounts. We don't pay them their ordinary through ordinary share capital. We don't pay them their share premium through share premium. We don't pay them their general reserve through general reserve. We don't pay them their revaluation reserve through revaluation reserve. No. Listen, what we do, we consolidate everything together in one liability. In other words, create a liability account for the ordinary shareholders where you will consolidate everything you owe to them in that account. Then when I come to payment, I'll now pay them once instead of paying them in piecemeal. So that's what we want to do in step 7, which says now you transfer. We want to create, listen, we want to create a liability account. I'm not paying the ordinary yet, not yet. But I want to create a liability account so that I take everything I owe to them in that account. And then when the time of payment will come, I'll only pay them once, not in piecemeal. So step number 7 says you transfer. Step number 7 says you transfer the balance of the ordinary share capital. You transfer the balance of the ordinary share capital to a liability account that we shall be calling, which we shall be calling ordinary shareholders members account. Ordinary shareholders members account. We open a liability account called ordinary shareholders members. Ordinary shareholders This is ordinary shareholders, members. Some books will call it ordinary shareholders sundries members account, whichever they call it. It's a liability. Now, step number 7, I've said, transfer the balance of the ordinary share capital. Transfer the balance of the ordinary share capital to the ordinary shareholders members. We know share capital is always a credit balance, and therefore to transfer that share capital, you will debit that share capital account and you will credit this account called members account. You come and say ordinary share capital, whatever it is. That's our step number 7, which says transfer the balance of the ordinary share capital to the ordinary shareholders members. Okay, good. We go to number 8. Number 8 is, listen, number 8 is this. We have said there are several things that me as a company I owe to my ordinary shareholders. Other than ordinary, what else could I be owing them? I owe them the reserves. So step number 8 says you transfer reserves. You transfer reserves to the ordinary shareholders members account, whether it's a positive reserve or it's a negative reserve. Positive reserve includes things like share premium, general reserve, revaluation reserve. A negative reserve could be retained losses, because don't forget, retained losses is still a reserve. And of course, retained losses will always be there, because that's the reason we are reconstructing this company. It has been making losses. It has been making losses. So our step number 8 says transfer reserves to the members, ordinary shareholders members account. If it's a positive reserve, let us assume like share premium, you will go debit that share premium, because share premium is a credit balance. You will go debit that share premium and you will credit ordinary shareholders members account. You come as credit here and you say yes, share premium, whatever it is. Good. That is if it's a positive reserve. If it's like general reserve, again, you debit general reserve, credit ordinary shareholders members. If there is a revaluation reserve, you debit revaluation reserve, credit ordinary shareholders members. Good. But if it's a negative reserve, like retained losses, which I've already said they will always be there, if you go to the P&L account of this company, you will find the P&L account having a debit balance. Retained losses are always a debit balance. So let the shareholders take the loss of this company. They are the owners of the company. Let them suffer the loss of this company. So you will credit P&L account and you will debit the members account, and you will debit the ordinary shareholders members. Good. So that's our step number 8, which says transfer reserves to the ordinary shareholders members, whether positive reserve or negative reserve. Good. Let me discuss number 9 first. Let me discuss number 9. Let me discuss number 9. Now, listen. For number 9, I want to take you back to number 1 and number 5. Number 1, I told you, listen. Number 1, I told you, close all assets taken over. Number 5, I said, with assets not taken over but sold by you, A Limited. Listen, what if you, company A, you have an asset which company B did not want to take over in step 1? 2, you as A Limited, you could not get somebody to sell it to in step 5. What do? Yet we are liquidating this company. You have an asset which was not taken over by company A, B, sorry, under step 1. 2, we can't get somebody to sell it to under step 5. What do? Yet we are liquidating, and we have said no account should remain pending. Listen to this now. Now, it is the responsibility of the owners of the business to suffer the loss of such an asset. If there is an asset that could not be taken over and could not be sold, In most cases, we refer to them as fictitious assets. Take, for example, Company A may not want to take over your goodwill. In your balance sheet as a Company A, you have an asset called goodwill or copyright or maybe trademark, maybe patents, and so on. These are assets that Company B could not be able to take them over. 2, you can't sell them. Of course, you can't sell an asset called goodwill on its own. No. Okay? What do? It is the owners of the business to suffer the loss. It's the owners of the business to suffer the loss. So let them take over the loss of that asset. Let them take over the loss of such an asset. So we are saying those assets, we refer to them as fictitious assets. So you transfer again, you transfer the fictitious assets. You transfer those fictitious assets to the ordinary shareholders members account. You transfer them to the ordinary shareholders members account. Listen, we know ordinary shareholders, we know assets are always a debit balance. So to close that asset, maybe it's copyrights, maybe it's patent, maybe it's goodwill, you go credit that asset and you debit the ordinary shareholders members account. Let them take over the loss of that asset. Let them take over the loss of that asset, whichever is the fictitious assets. Whatever the fictitious assets are, whatever it is, you will debit the ordinary shareholders members and you credit fictitious assets. Good. That's our step number 9. Now, before we go to number 10, because there are about 15 entries, before we go to number 10, 11, up to 15, I think maybe we can now put down something on what we have already said. We can now put down something on what we have already said. Okay? Now, maybe before we put it down, let me mention something to this. Maybe before we put them down, let me say something. Before we put down those accounting entries, listen. You may be here and you have a friend who is willing to do online classes. Tell your friends that we are offering online classes for financial management of the intermediate level. We are offering financial management, online classes for financial management of the intermediate level. We are also offering online classes for financial reporting of the intermediate level. We are also offering advanced financial reporting of the advanced level. Tell them we are also offering financial accounting of the foundation level, and that of ATD1 and ATD2. They also have accounting there. So these are the 4 subjects in which we are offering online classes for. Okay? So they can join our online classes for any of these 4 subjects. That is financial management of the intermediate, financial reporting of the intermediate, advanced financial reporting of the advanced level, and for financial accounting of the foundation level and the one of ATD1 or 2. Good. Now listen. If they are not able to join the live classes, then tell them that they can buy what we call pre-recorded videos. They can buy what we call pre-recorded videos so that they watch the videos at their own free time. They can watch the videos at their own free time, at their own pace. They can buy the pre-recorded videos and watch the videos at their own free time, at their own pace. Okay? For them to reach me, tell them the number is 0722 658875. 0722 658875. They can text or call me on that number for more information. Okay? Good. Now, for everyone who is watching, if you are watching this video and you have not subscribed to my YouTube channel, please do subscribe. Click that subscription button down there to subscribe. Okay? If you have not subscribed, you will be notified whenever we post new videos into the YouTube. You will be notified. So click that subscription button if you have not subscribed to my YouTube channel. The other point is, please click that like button. Click that like button to like the video. I hope by now you have understood something as far as external reconstruction is concerned. I hope you have understood something. So click the like button to like that video, to like the video. Okay, good. I think that's all I wanted to say. That's all I wanted to say before we continue and put down the summary notes on those for those 9 entries before we finish up to 15. So let's put down those entries now. So put down the subtopic, external reconstruction. Put down the topic, external reconstruction. External reconstruction. Then you say this. External reconstruction takes place. External reconstruction takes place when a company is liquidated. External reconstruction takes place when a company is liquidated and they sell their business. When a company is liquidated and sell their business to another existing company, or a newly formed company. External reconstruction takes place when a company is liquidated and they sell their business to another existing company or newly formed company. Okay, good. Let's now go. I have another subheading. Entries in the books of the selling company. 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 Number 1. Entries in the books of the selling company. Number 1. Close all assets taken over. Close all assets taken over at their book values. That's important. Close all assets taken over at their book values to the realization account. Close all assets taken over at their book values to the realization account. Close all assets taken over at their book values to the realization account. Close all assets taken over at their book values. Close all assets taken over at their book values to the realization account. So put down the double entry: debit realization, credit assets. Debit realization, credit assets. That is the double entry. You debit realization, you credit assets. Okay. Number two. With liabilities taken over. With liabilities taken over by the purchasing company. With liabilities taken over by the purchasing company. With liabilities taken over by the purchasing company. Debit liabilities. Debit liabilities. Credit realization. With liabilities taken over, debit liabilities, credit realization. With liabilities taken over, debit liabilities, credit realization. That's number 2. Number 3. With the purchase consideration. With the purchase consideration. With the purchase consideration. With the purchase consideration. Debit. Purchasing company. Debit purchasing company. The examiner will give you the name of the purchasing company. Debit purchasing company, you can put in bracket data, credit realization. Debit purchasing company, credit realization. Debit purchasing company, credit realization. That's our entry number 3. We now go to number 4. We go to number 4. Number 4. With liquidation expenses, with liquidation expenses, with liquidation expenses paid for or incurred, with the liquidation expenses paid for or incurred, with the liquidation expenses paid for or incurred, debit realization, debit realization, credit bank stroke provision for liquidation expenses. So if you paid, you credit bank. If you incurred, you credit provision for liquidation expenses. Either way, you must debit realization. Okay? So we are debiting realization. It's an expense. Otherwise, in a normal business, I would have debited P&L. But we are not running a normal business, as I said. We are liquidating, so our operating account becomes realization. That's number 4. Number 5, if you are through, number 5, let me explain, I'll dictate it. Number 5 says, with any assets not taken over, with any assets not taken over by the purchasing company, with any assets not taken over by the purchasing company but sold, with any assets not taken over by the purchasing company but sold by the selling company, debit bank credit asset, debit bank credit asset, debit bank credit asset. NB below there, NB, with the balance in the asset account, with the balance in the asset account, with the balance in the asset account being either, with the balance in the asset account being either a gain or loss on disposal, with the balance in the asset account being either a gain or loss on disposal, being either a gain or loss on disposal, comma, transferred to the realization account, transferred to the realization account, transferred to the realization account. Good. So that's number 5. Number 6. With liabilities not taken over, with liabilities not taken over, with liabilities not taken over by the purchasing company, with liabilities not taken over by the purchasing company but paid by the selling company, with liabilities not taken over by the purchasing company but paid by the selling company, debit liabilities, credit bank, debit liabilities, credit bank. Then you write NB, with the liabilities not taken over by the purchasing company but paid by the selling company, you debit liabilities, credit bank. Then you consider NB, with any discount received from creditors, with any discount received from creditors, debit, creditors, credit realization. With any discount received from creditors, debit creditors, credit realization. That's number 6. We want to go to number 7 now. Let's go to number 7 now. Number 7. Number 7, if you are through with number 6, put it down. Say this. Transfer the balance of the ordinary share capital. Transfer the balance of the ordinary share capital. Transfer the balance of the ordinary share capital to transfer the balance of the ordinary share capital to the ordinary shareholders members account. Transfer the balance of the ordinary share capital to the ordinary shareholders members account. Transfer the balance of the ordinary share capital to the ordinary shareholders members account. Debit, ordinary share capital. Debit ordinary share capital. Credit ordinary shareholders members. Credit ordinary shareholders members. Okay, that's number 7. That is number 7. That is number 7. We go to number 8. Number 8. Transfer. Number 8. Transfer reserves. Transfer reserves to the ordinary shareholders members. Transfer reserves to the ordinary shareholders members. Then below that you say number A. Below that you say number A. If positive reserve. Number A. If positive reserve. If positive reserve, e.g. share premium. E.g. share premium. E.g. share premium. Debit share premium. Debit share premium. Credit ordinary shareholders members. Credit ordinary shareholders members. Credit ordinary shareholders members. Number B. Number B. If negative reserve. If negative reserve, e.g. share premium, e.g. retained losses. If negative reserve, e.g. retained losses. If negative reserve, e.g. retained losses. Debit ordinary shareholders members. Debit ordinary shareholders members. Credit P&L account. Credit P&L account. That is profit and loss. That's our entry number 9. Number 8, sorry. That's entry number 8. We go to number 9. We go to number 9. We go to number 9. Number 9, if we are through with number 8, transfer, number 9, transfer fictitious assets. Transfer fictitious assets to the ordinary shareholders members. Transfer fictitious assets to the ordinary shareholders members. Transfer fictitious assets to the ordinary shareholders members. E.g. goodwill, patents, whichever goodwill, patents, copyrights, those ones. In most cases, they are normally in form of intangible assets. So we debit, we are transferring them. So we are saying transfer fictitious assets to the ordinary shareholders, members. Good. You debit ordinary shareholders, members. You debit ordinary shareholders, members. Ordinary shareholders. Members. You credit fictitious assets. Fictitious assets. Good. That's how far we have gone. So let me go back and now discuss the remaining ones before we put them down. So finish. I want to go back and discuss the remaining ones before we put them down. So those 9 are the ones we have so far discussed. So let me discuss the remaining. Okay. Okay, so let me go back to where we were listing them. Okay, so we have said this. Number 10, or maybe let me put it, I don't know whether I have enough space. Oh, I don't have enough space. Okay, no problem. I can still come down here. Okay, number 10. Listen to this now. Listen. Apart from the ordinary shareholders, I told you when a company is liquidated, the stakeholders must be paid what is due to them. The stakeholders. Finally, before this company is liquidated and whatever, the stakeholders have to be paid. Who are the stakeholders? I said the ordinary shareholders, maybe preference shareholders. So let us assume for now again that our company has some preference shareholders. I want to assume that our company has preference shareholders. What do? That's what I want to talk about now. Again, listen, we shall pay them. But before we pay them, again, there are several things that you as a company, you owe to them. There are several things that you owe to them, and so you can't pay them in piecemeal. You owe them the share capital. Who? The preference shareholders. If your company has not paid them the dividends in arrears, there is something we normally call preference dividends in arrears. If the company has not been paying them the arrears, and if, of course, listen, of course, it's more likely they could not have paid them. Why? Because we have been making losses. Okay? So we are saying, step number 10 says, now you transfer again the balance of the preference share capital. You now transfer the balance of the preference share capital. Maybe I could even have come back here. Okay. You transfer the balance of the preference share capital to an account we shall be calling, listen, to an account we shall be calling preference shareholders members account. The way you opened preference share capital, preference shareholders, no, the way you opened ordinary shareholders members, now you will be required to open preference shareholders members account. Okay, let me just open it down here. So you will be required to open this account called preference shareholders members. It's a liability account again, where I want to combine everything that I owe to them into one account so that I don't pay them in piecemeal. So one thing I owe to my preference is their preference share capital. So I debit preference share capital to close it. I credit this account and I come and say a preference share capital. That's our step number 10. Okay. Still under number 10, listen, still under number 10, if your company has not paid the preference shareholders their dividends, Maybe the question tells you for the last 2 years or 3 years, we have not paid them the dividend. Now, if you go to the balance sheet of this company, you will not see a liability. You will not see a liability by the name of preference dividends in arrears. You will not see a liability by the name of preference dividend. Remember, even when we were discussing the topic of internal reconstruction, I said, and I gave an example of a contingent liability. When we were discussing internal reconstruction, we said one example of a contingent liability is what we were calling preference dividends in arrears. And I told you that time that even if you go to the balance sheet of the company, you will not find the liability there. Listen, whenever a company owes the preference shareholders their dividend, what they just do is to keep knowing we have not paid them for the last 2 years, last 3 years, but they don't show it as a liability in the books. That's why we are saying it's normally an example of a contingent liability. Okay? Now, when we were doing the topic of internal reconstruction, listen, when we were doing the topic of internal reconstruction, we had to capitalize that liability. In other words, make it now a liability. It is not in the books. We were making it a liability. How? You remember, we were debiting the account called capital reduction. For the topic of internal reconstruction, we were debiting the account called capital reduction, and we were crediting the account called contingent liability. Okay? But this time, the concept is the same, that we as a company A, we have not paid our preference shareholders their dividends for the last 5 years or 2 years, whichever the question will tell you. So which means again, we have to capitalize it. But this time, I don't capitalize it by taking it to the contingent liability account. Already, I've opened an account for liability of the shareholders here called preference shareholders members. It represents a liability for everything I owe to them. So, to crystallize that liability, which is preference dividends in arrears, you will debit realization account here. You will have to debit realization account. Whatever is the preference dividends that are in arrears, you debit realization and you credit preference shareholders members here. And you come and credit here and you say preference dividends that are in arrears. That is our step number 10. So step 10, I'm doing two things. Number 1, I've said transfer the balance of the preference share capital to the preference shareholders members. I've debited preference share capital. I've credited preference shareholders members. Then I've gone further and said, if there are any dividends that are still in arrears, you will debit realization and you credit the members. That's our step number 10. Good. So let me go to number 11. Let me now go to step number 11. Now listen. For number 11, I want to take you back to number 3. For number 11, I want to take you back to number 3. Number 3, you remember we said, with the purchase consideration. That time, we created a data by the name of company B. We were A Limited. We created a data by the name of company B. We debited the purchasing company here by 50 million. We debited the purchasing company. Where was it? Here. There must be somewhere. Here. Good. We debited the purchasing company by this 50 million. We credited realization. Now listen. A time has come for them to pay us that 50 million. A time has come for them to pay us this 50 million. Listen. Company B might decide they are going to pay you part of that 50 million, maybe in cash, and maybe part of it in terms of shares, and maybe part of it in terms of debentures, or all of it in cash, or all of it in terms of shares. It is the question that will guide you. Okay? But let us for now assume that the question tells you that out of 50 million, 10 million was paid in cash, 20 million was paid in terms of debentures, and maybe another 20 million in terms of shares. So our step number 11 says, now listen, our step number 11 says, with the receipt of the purchase consideration. Now we are receiving the purchase consideration from this data. If you are receiving cash, you will debit cash, that 10 million, you will credit the purchasing company, you come and credit here 10 million. If you are receiving shares, you will debit shares by 20 million and you credit the purchasing company 20 million. Listen, I am receiving shares. I am not the company issuing the shares. Listen, if the company is issuing shares, they credit share capital. But when we are receiving shares, we are receiving it as an asset. That's why we are debiting shares account as an asset. We are receiving shares of shares of B Limited. So we are receiving it as an asset. We are receiving shares of B. They are paying us in form of shares. So we shall debit this account called shares in B Limited and you credit the purchasing company. I've said we are receiving them as an asset. If you are being paid part of the 50 in terms of debentures, then it means you are receiving debentures. You will debit debentures of B Limited. You will debit debentures of B Limited and you credit the purchasing company. You come and say your debentures 20 million. Remember again, you are receiving, not issuing. You are receiving debentures. Okay? So you are receiving them as an asset. The company that is issuing them will be the one to credit share debentures or to credit share capital. But you, as company A, you are only receiving these things. Okay? So that's our step number 11, which says, with the receipt of the purchase consideration, with the receipt of the purchase consideration, either in form of cash, shares, or debentures, you debit cash, you debit shares, you debit debentures, and you credit the purchasing company. Good. That's our step number 11. Number 12. Now listen. You A now, you have cash, you have shares, you have debentures. You have received them. I told you that when a company is liquidated, the stakeholders must be paid what is due to them. The stakeholders must be paid what is due to them. Are you there? Now that we have cash, we have shares, we have debentures, who do we pay first? Don't forget, we owe the ordinary shareholders and we owe preference shareholders. In fact, we have opened the two liability accounts called members account. So who do we pay first? Listen, you all know that when a company is liquidated, preference shareholders normally rank first in order of liquidation. They rank first before ordinary. In fact, ordinary shareholders are the last people to be paid. So our step number 12 now says, pay the preference shareholders. Pay preference shareholders what is due to them. Pay the preference shareholders what is due to them. Find out from the question, are you giving them the cash? Are you giving them the debentures that you received? Or are you giving them the shares? It is the question that will guide you on that. Let me assume that you are told you are giving them cash. Remember, you received cash, you debited it here. Now that you are using it to pay the preference, you will credit cash here and you will debit the members account here. You now come and debit the members, you come and say your preference 10 million. If you are giving them shares, you go credit the shares. You remember you received them, you debited, now you are using it. Go credit shares and you debit the members, whatever it is. If the question tells you you are giving them debentures, remember you received them as an asset, go credit those assets, debit the members. That's our step number 12, which says pay the preference shareholders what is due to them. Pay the preference shareholders what is due to them, either in form of cash, shares, or debentures. You credit cash, credit shares, credit debentures, and you debit the preference shareholders members. Good. That's our step number 12. That's our step number 12. We go to number 13. Now listen. Still under number 13, I'm still in this account called preference shareholders members. Now, once you pay them, normally there will be a balance in this account. There will be a balance in this account. Look at this. On the credit side of this account, this is what you owe to the preference. Let me assume it amounts to 2 million. I'm assuming. When you add what you have given to them on the debit, when you add all of that, let me assume it comes to 1,800. So I owe them 2 million, but I'm paying them 1.8 million. There is a difference of how much? 200. On which side? Debit. That balance in the account could either be what we call a gain or loss on payment. It's either gain or loss on payment. Listen, now I owe them 2 million. I've paid them 1.8 to settle the liability. So it means I am paying them less than I owe to them. I'm paying them less than I owe to them. Automatically it means therefore, as a company, I've made a gain. So that gain of 200, I will debit the members and I will credit realization. I take it to the realization account. Don't forget I told you we are not running a normal business. Otherwise I would have taken it to the P&L, but we are not running a normal business. We are liquidating. So we take it to the realization account. What if, yes, I owe them 2 million on the credit side, but maybe from the question, we realize we are giving them total payments amounting to 2.8 on the debit. Suppose the total payments are coming to 2.8. So it means therefore that I'm giving them more than I owe to them. I'm giving them more than I owe to them. There's a difference of 800, which is on the credit side. That is obviously a loss on payment. When you are paying them more than you owe to them, that is a loss on payment. That's a loss on payment. Take it again to the realization account. So that's our step number 13, which says, with the balance in the preference shareholders members, with the balance in the preference shareholders members being either gain or loss on payment, you transfer it to the realization account. You transfer it to the realization account. That's all for step number 13. Let me now go to number 14. For number 14, I want to take you now to this account we were calling realization account. Here's one. We are selling our business. We as company A. Could we have sold our business at a gain or loss? That's what we want to know in step 14. So you come to the realization account and get the balance in this account. The balance in this account will either be a gain or loss on realization, on selling your business. Look at this account. On the debit side, these are the assets I gave out to the company. These are the expenses I incurred. On the credit side, I'm going to receive 50 million. So suppose the credit side is more than the debit side, meaning the difference is on the debit side. What does it imply? It implies that what you as a company A you are receiving from B is more than what you are giving to them on the debit side. So it is obvious you are selling your business at a gain. If what you are going to receive, which is on the credit side, is more than what you are going to give out, then it means you are selling your business at a gain. Who takes over the gain of selling this business? Obvious, it's the owners of the company, and the owners of the company are the ordinary shareholders. So with the balance in that account, you will debit the ordinary, so you debit realization, you credit ordinary shareholders, members. you credit ordinary shareholders members. What if the difference is on the credit side? What does it mean? It means what you are giving out on the debit, is more than what you are going to receive on the credit, So you are selling your business at a loss. You are receiving only 50, but maybe what you are giving out is more than 50 on the debit. Therefore, the difference being on the credit side, that's a loss. Again, let the owners of the business take it. Who are the owners? The shareholders, ordinary shareholders. So you will credit realization and you debit the ordinary shareholders members. Are you there? Good. So you come and debit. Let us assume it's a loss. You must have debited realization and you credited ordinary shareholders members. We had opened it earlier here. You came and said here, realization. Whatever it is. That's our step number 14. Number 15 and the last one. Number 15 and the last one is this. Listen. I told you everybody must be paid what is due to them so that they go their way. So the last person to be paid are the ordinary shareholders. That is step number 15, which says pay the ordinary shareholders what is due to them. Pay the ordinary shareholders what is due to them. Now listen. The question might tell you are giving them the cash, or you are giving them shares, or you are giving them debentures. Remember, you received cash, you received shares, you received debentures. But it's the question that will guide you. Which among those items that you received are you giving them out to the ordinary shareholders? If you are giving them cash, go credit cash. Debit the ordinary shareholders members. It's a liability I'm paying, so I debit it. If I'm giving them shares, I go credit the shares that I received and I debit the members. If I'm giving them debentures, I go credit debentures and I debit the members. That's all on the entries in the books of the selling companies. Those are the 15 entries in the books of the selling company. Now listen. Before we put them down, the remaining ones, listen, I want you to understand the process, not to cram the process. Listen, what did I do here? If you look at this process, I started by closing the accounts. Number one, close the assets taken over, liabilities taken over. Then number 3, create a data by the name of the purchasing company. Now listen, in most of your past paper questions, you will rarely get a question which has this entry number 5 and number 6. Rarely will you get a question which has the entries number 5 and 6, whereby assets were not taken over but they were sold, or liabilities were not taken over but they were paid. In most questions you are told the company B took over the assets, all of them from A. Then you are told the liabilities were all taken over. But I've just given the entry number 5 and 6 just in case. But I've said they are rare. You may not be given a question where assets were sold by you A, meaning they were not taken over by B, but you sold them on your own. But if you sold them on your own, fine. Just debit bank, credit asset. No problem, just like any other asset. With the liabilities, if you never gave them to B, but you paid it on your own, it's a normal liability. Just debit liability, credit bank. Okay? So our entry number 5 and 6, they are rare. So what I want you to see, without the 5 and 6, what is it that I'm doing? I am closing. Listen, I am closing the accounts on top there. Okay? Then, number 7, listen to this now. Number 7, 8 and 9. Number 7, 8 and 9, they were all related. Which is, all these things were belonging to the ordinary shareholders. 7 I transferred the share capital of the ordinary to the shareholders members. 8, I transferred reserves to the ordinary shareholders members. 9, I transferred fictitious assets. So what I was doing in step 7, 8, and 9, listen, I was opening a liability account for the ordinary shareholders. Then, listen, when I came to number 10 here, where is it? Here. I did the same for the preference. I opened a liability account for the preference. So what I want you to understand is the flow of the transactions. I started by closing the accounts. Close the the assets, close the liabilities, create a data. Listen. Then, once I do that, I had to create liabilities for the stakeholders. For the ordinary shareholders, opened an account called ordinary shareholders members, put everything there, whether share capital, share premium, general reserve, fictitious assets. That's what I did in number 7, 8, and 9. Then I did the same for preference. I opened a liability account for preference. Anything I owe to them, take it there. One is share capital, the other one is preference dividends in arrears for this question. Okay, so that's what I did. I started by closing the accounts. 1, 2, 3. Okay, number 4, because of liquidation expenses, it could be there. Most questions have liquidation expenses, but I've told you number 5 and 6, no question, mostly rare. 7, 8, and 9, they will be there. Creating liabilities of the ordinary, that you must do. Number 10, you must create liabilities, okay, of preference. If the preference shareholders are in the company, good. Now listen. So once I close the accounts, then I've created the 2 liabilities, or whichever liabilities I'm creating for the stakeholders. Listen. Now I receive the purchase consideration. That's number 11. You can see it there. Once I receive now, I start paying. Are you there? I start paying the stakeholders. I've paid the preference, I've finally paid the ordinary, and everybody goes their way. That is the procedure for closing the books of the selling company. What have I said? Close the assets, close the liabilities. So we are closing the books. Create a data by the name of the purchasing company. Then create liabilities for stakeholders with anything you owe to them. Receive the purchase consideration. Start paying the stakeholders. That's all we are saying for all this. They look to be many entries, yes, but once you understand them, don't cram. Understand the process. Close the accounts, create a data, open liabilities for the stakeholders, receive the purchase consideration, start paying the stakeholders. Final person to be paid at the ordinary. Then you close the books. Okay. So now we can put down. The remaining entries. We had gone up to number 9. Let's now put down from number 10. We had gone up to number 9, I think so. Yes. Now let's go to number 10 as part of the notes now. Let's go back to number 10 as part of the notes now. So see this, number 10. Transfer the balance. Transfer the balance of the preference share capital. Transfer the balance of the preference share capital to transfer the balance of the preference share capital to the preference shareholders members. Transfer the balance of the preference share capital to the preference shareholders members. Debit preference share capital. Debit preference share capital. Credit preference shareholders members. Credit preference shareholders members. Debit preference share capital. Credit preference shareholders members. Then you say this NB. Under that, NB. You say this if there are preference dividends in arrears, if there are preference dividends in arrears, if there are preference dividends in arrears, debit realization, debit realization, credit preference shareholders members, debit realization, credit preference shareholders members. I've said if there are preference dividends in arrears, debit realization, credit preference shareholders members. That's number 10. So finish, we go to number 11. We want to go to number 11. Number 11, you say this: with the receipt of the purchase consideration, with the receipt of the purchase consideration, with the receipt of the purchase consideration, either in form of cash, shares, or debentures, with the receipt of the purchase consideration, either in form of cash, shares, or debentures, with the receipt of the purchase consideration, either in form of cash, shares, or debentures, debit, cash, stroke, shares, stroke, debentures. Whatever you are receiving, you debit cash, stroke shares, stroke debentures, and you credit purchasing company. Purchasing company, put in bracket data. Remember, now you are receiving from your data, so you credit the data. That's our step number 11, which says with the receipt of the purchase consideration, either in form of cash, shares, or debentures, you debit cash, or you debit shares, or you debit debentures, and you credit the purchasing company. That's our step number 11. So finish, we want to go to number 12. So finish, we go to step 12. Then you say this, number 12. Number 12, pay the preference shareholders, pay the preference shareholders what is due to them. Pay the preference shareholders what is due to them. Pay the preference shareholders what is due to them. Pay the preference shareholders what is due to them, either in form of cash. Pay the preference shareholders what is due to them, either in form of cash, shares, or debentures. Pay the preference shareholders what is due to them, either in form of cash, shares, or debentures. So debit preference shareholders members, we are paying them. Debit preference shareholders members, credit cash, stroke shares, stroke debentures. So whatever it is that you are using to pay them, use it. Okay? That's our step number 12. Pay the preference shareholders what is due to them, either in form of cash, shares, or debentures. You debit preference shareholders members, you credit either cash or shares or debentures. Okay, we go to number 13 now. Number 13. Number 13. With the balance in the preference shareholders members, with the balance in the preference shareholders members, with the balance in the preference shareholders members, being either a gain or loss, with the balance in the preference shareholders members, being either a gain or loss, on payment, with the balance in the preference shareholders members account being either gain or loss on payment, transferred to the realization account, with the balance in the preference shareholders members account being either gain or loss on payment, transferred to the realization account. Then you say number A, if gain, debit preference shareholders members, credit realization. Debit preference shareholders members, credit realization. That is if gain. Debit preference shareholders members, you credit realization. Remember, you are paying them less. So you are making a gain. So there will be a balance on the debit side of that account. So you debit that account, called members account, you credit realization. Number B, if loss, debit realization, credit preference shareholders members. Debit realization, credit preference shareholders members. Okay, that's our step number 13. Finish. We want to go to step 14. We want to go to step number 14. I hope you are through with the copying of that step for 13. Number 14, we have said, number 14, say this, with the balance in the realization account, being either a gain or loss on realization, with the balance in the realization account being either gain or loss on realization, transferred to the ordinary shareholders members, with the balance in the realization account being either gain or loss on realization, transferred to the ordinary shareholders members. Then you come and say here, A, if gain, that could be you are selling your business at a gain, you debit realization, you credit ordinary shareholders members. Remember, I told you, you are selling your business at a gain, meaning what you are receiving on the credit was more than what you are giving out. That was a gain to us. So you debit realization and you credit the members. That is number A, if gain. B, if loss, meaning you are debiting more than what you credited in the realization. In other words, you gave out more than what you're receiving. So you will debit ordinary shareholders members, and you credit realization if you sold your business at a loss. Good. That's our step number 14, sorry. So finish, we go to the last one, number 15. Finish, we got the last one, number 15. Number 15. I told you the last person to be paid is who? the ordinary shareholders. So we come and say number 15, pay the ordinary shareholders what is due to them. Pay the ordinary shareholders what is due to them. Pay the ordinary shareholders what is due to them, either in form of cash, shares, or debentures. Pay the ordinary shareholders what is due to them, either in form of cash, shares, or debentures. Debit ordinary shareholders members. Debit ordinary shareholders members. Credit cash, stroke, shares, stroke, debentures. It all depends on what the question tells you. You are giving them. You debit ordinary shareholders members, credit cash, stroke shares, stroke debentures. That's all for the entries in the books of the selling company. Okay? So maybe for now we can stop there. Maybe for now we can stop there. We pick it up from there next time, where now we shall discuss the entries in the books of the purchasing, in the books of the purchasing company. Listen, in the books of the purchasing company, there are not many. There are only about 6 of them. But the entries of the books of the selling, that's where there are many. But I've told you, you don't have to cram them. Just understand the flow. What have we done? Closing the books. You remember? Good. Creating a data for purchase consideration. Creating liabilities for the stakeholders. Ordinary shareholders members, preference shareholders members. Receive the purchase consideration in whatever form. Start paying. Pay the ordinary first, then finally pay the preference. No, pay the preference first, then finally pay the ordinary last. Okay? That's the flow we have followed. Otherwise, I told you, most questions will not have assets not taken over but sold. Most questions will not have assets not taken over but paid. That was my entry number 5 and 6. Most questions don't have them. Okay? But we are putting them there just in case there is a question that may be tested where a company sold their own assets or paid their own liabilities. Good. Let's stop there for now. We pick it up from there next time, where we shall now proceed from there. Otherwise, I've mentioned that please tell your friends that we are offering the following online classes. One, we have said, this is financial management of the intermediate. Tell them we are offering financial reporting of the intermediate level. We have online classes for advanced financial reporting. For advanced, we have either early morning or evening or pre-recorded, no problem. For financial accounting of foundation level and the one of ATD. Then we have said if they can't join the live class, then they can buy the pre-recorded videos. Okay, good, where they can watch the videos at their own free time. Then I've said they can reach me on this number 0722658875. Then I've asked you, please subscribe to my YouTube channel by clicking that subscription button down there. And I've also said, finally, like the video. I hope you have understood something today. You can even comment. Maybe you can even comment on the video if you have understood something. Good. So you can put in a comment down there on the video. Thank you very much. See you next time. So please like the video. Hoping you have liked it. You can even put a comment down there. You can put a comment on the comment chat of the video that is on the YouTube. You can comment. Okay? Bye for now. See you next time. See you next time. Bye for now. See you next time when we shall now go to the books of the purchasing company now.